Hey everyone, and welcome to another episode on the Joan Wick channel. I am back. It's been a minute, and let's get into where we just left off. And I believe that was SMT Divergence. And so, if you look back at that graph, that diagram actually that I made, we only have technically about two concepts left. And that's this IFVG and the mitigation block. And the reason why we have two IFVGs is because there is a hidden third concept. And I'll explain that to you as we get into this video. So yeah, let's jump right into that. You'll see that IFVG has the word fair value gap in it. That's because they are very closely related. And that's because an IFVG, what that is simply a fair value gap that's been inversed. So if you look at this over here, you'll notice that where our fair value gap is, immediately we notice that's our fair value gap, right? The gap that's in between our two candle wicks. So where would our inverse fair value gap be? Well, it would simply be this old fair value gap over here. Simple, right? An inverse fair value gap is simply a fair value gap that's been inversed. We closed over it. And so how does that differ from our fair value gaps? Well, we already know how we enter on fair value gaps. If you have been paying attention to some of my reels and shorts, you'll notice that I released a strategy on how to trade fair value gaps and IFVGs. So if you see here, this will be our liquidity sweep. I have a bunch of lows accumulating over here. Here's our liquidity sweep. Also, if you don't know how to spot a liquidity sweep, I do have a link in my description on how to identify those. So if we have our liquidity sweep here, to trade fair value gaps, we first look for our market structure shift. There, that will be our market structure shift. Once we confirm that we're shifting structure, we then look for price to tap into the fair value gap that formed on the leg that created the market structure shift. And so we enter on that fair value gap, right? Since this is a huge fair value gap, it makes more sense to enter on the consequent encroachment. If you remember that big word, yes, that is the 50% of pretty much any PD array is the consequent encroachment. That's exactly how our trade would go if we entered on using this strategy. I call this one the sweep, shift, and strike. In other words, my triple S strategy. You can go look at that link, of course, in description. And that is essentially how we enter on a fair value gap. Now, with an IFVG, you can already see that this would be our entry. Why? Because we use inverse fair value gaps the same way we use every other PD array. We use it within context. We don't just take any sort of inverse fair value gap. We use them within context, within our rules, within our setup. So we wait for liquidity sweep, and then we apply our entry model. And in this case, instead of our fair value gap entry model that I mentioned and showed, we are using our inverse fair value gap entry model. This one is simply the double tap strategy if you're looking for it in the free resources. So traders will typically use fair value gaps to frame a reversal. That's where we use fair value gaps. So after liquidity sweep, we wait for a inverse fair value gap to form. And where do we enter? Normally we would enter on the close of the candle. But since this candle is too big, we can wait until price taps into that inverse fair value gap. We can do the same thing with our risk and targeting the buy side liquidity, right? So that's essentially how we use inverse fair value gaps. Simply an inversion of a fair value gap that we use to frame as part of a reversal, and usually it allows us to get an earlier entry without having to wait for additional confirmation to enter in later, like this fair value gap. We can enter earlier as soon as we see an inverse fair value gap. We can enter on the candle close. In this example, this candle close was a bit too far, but you can see in another example. Here's an example where we would use a inverse fair value gap entry. We take this as our liquidity sweep. Normally for our fair value gap entry model, we'd wait for breaker structure, right? But look how far our fair value gap is that we finally tap into. This is where our inverse fair value gap entry would be useful, because why? We get a nice earlier entry, right? Here's our inverse fair value gap. And so how we'd enter this, we'd enter on the candle that closed, that basically inversed and closed above this inverse fair value gap. And then we'd enter there and target our buy side. And so you see that provides a much cleaner and earlier entry for your trade position. And that's essentially how you'd use inverse fair value gaps when we are framing a reversal. And for fair value gaps, you'd much rather use them to apply a retracement entry. So before I forget, the last thing I did want to mention was a BPR. A BPR, I don't acknowledge as much, because they essentially, what BPR is when you find, like this example, a fair value gap overlapping with an inverse fair value gap. That can provide an entry as well. BPRs are just more of a confluence, because you have two concepts overlapping each other, but they can be used in the same way. If I see there's a fair value gap overlapping my inverse fair value gap, I'm still focusing on just one of the two when I'm taking my entry. BPRs are kind of like an additional confluence to note of. But what BPR stands for is a balanced price range. So as you know, fair value gaps are an imbalance in price. And so when we know when price moves, price seeks to rebalance imbalances. So we'll see that price tapping into fair value gaps and inverse fair value gaps. But when we have inverse fair value gaps and fair value gaps overlapping, we have a much greater point of interest, and we just refer to that overlapping as a balanced price range, or BPR. And that's essentially everything you need to know on IFVGs, FVGs, and BPR. The secret, to be honest, for all IC3 traders, if you're new or you've been at it for a while, just wait for a liquidity sweep and apply your entry model. You don't have to find all of the concepts happening at once. You don't have to find the breaker block overlapping with a order block overlapping with a fair value gap, all of them at once. It does not just happen like that. It's more likely that we'll find one or two of them, or three, even three sometimes, after your liquidity sweep. But make sure you follow those rules and apply maybe one or two of those concepts, and you'll find that taking trades will be much easier if you just simplify them that way. And most importantly, managing your risk. I will come out with a video and a guide as well on how to manage your risk. So stay tuned for that, and make sure to download the guides I have out now. Got my 2 strategies, and I've got my liquidity sweep guide. So please check the description for those links and download them. They are free. So take full advantage of that. And so that concludes our video. So I will see you guys in the next one.